Wall Street thrives on one fundamental deception, that economic complexity requires expert intermediaries to navigate markets successfully. This elaborate fiction serves a trillion-dollar industry built on convincing Americans that sound economic principles are too sophisticated for individual understanding. The truth is precisely the opposite. Through decades of developing praxeology, I discovered that economic laws are logical, universal, and accessible to any thinking person willing to understand human action. Wall Street's business model depends on maintaining economic mystification. They profit from confusion about money, markets, and investment principles that should be as clear as basic arithmetic. Financial intermediaries, central bank policies, and complex derivatives exist primarily to extract wealth from productive Americans while delivering minimal actual value. The more obscure they make economic principles, the more dependent you become on their expensive services. Today, I'll reveal the simple, logical economic truths that Wall Street desperately hopes you never discover. These aren't abstract theories requiring advanced mathematics or insider knowledge. They are fundamental principles of human action that govern all economic behavior, from your daily purchasing decisions to massive institutional investments. Once you understand these principles, you'll see through Wall Street's elaborate deceptions and make sound economic decisions based on logical reasoning rather than expensive financial advice. Chapter 1: The Myth of Market Complexity. Wall Street's greatest achievement isn't creating wealth, it's creating the illusion that wealth creation requires their sophisticated intervention. This fundamental deception underlies every expensive service they sell to American investors. The reality I discovered through praxeological analysis is that markets operate according to simple, logical principles that any individual can understand and apply. Consider how Wall Street describes market behavior: unpredictable volatility requiring complex algorithms, expert analysis, and professional management. They present charts, statistical models, and mathematical formulas that suggest market movements are mysterious forces only trained professionals can interpret. This elaborate theater serves one purpose: convincing you that successful investing requires paying substantial fees for their expertise. The truth revealed through human action analysis is remarkably different. Markets are simply the aggregate result of individual human choices made by people pursuing their personal goals with available resources. Every market movement reflects millions of individuals making rational decisions based on their subjective valuations and expectations. There's nothing mysterious about this process. It's the same logical decision-making you apply when choosing between different products at the grocery store. Wall Street profits from obscuring this simple reality because clarity would eliminate their role as expensive intermediaries. If Americans understood that successful investing follows the same logical principles as any other economic choice: careful evaluation of alternatives, consideration of opportunity costs, and rational allocation of scarce resources, the demand for expensive financial services would collapse overnight. The praxeological approach reveals that market prices contain all the information necessary for sound economic decisions. When millions of individuals freely choose how to use their resources, market prices automatically coordinate these choices more efficiently than any centralized authority could achieve. This spontaneous coordination mechanism works precisely because it harnesses the distributed knowledge and preferences of all market participants. Wall Street's complexity narrative serves another crucial function: distracting attention from the fundamental role of sound money in wealth preservation. They promote elaborate investment strategies while ignoring how Federal Reserve monetary policy systematically destroys the purchasing power of your savings through inflation. Complex portfolio management becomes unnecessary when you understand that sound money automatically preserves wealth over time without requiring expensive professional intervention. Chapter 2: How Central Banking Enriches Financial Intermediaries. The Federal Reserve System represents the greatest wealth transfer mechanism in American history, systematically channeling resources from productive citizens to financial intermediaries through the magic of money creation. Wall Street's relationship with central banking isn't coincidental, it's the foundation of their business model and the source of their extraordinary profits. When the Federal Reserve creates new money through bond purchases or lending operations, this newly created money doesn't enter the economy uniformly. It flows first to major financial institutions, government bond dealers, and large corporations with direct access to Federal Reserve credit facilities. This gives Wall Street firms first access to new money before prices throughout the economy adjust to reflect the increased money supply. This sequence creates what economists call the Cantillon effect. Those closest to the money creation process benefit at the expense of those furthest from it. Wall Street receives new money when it still possesses full purchasing power, allowing them to buy assets, extend loans, and make investments at pre-inflation prices. By the time this new money circulates through the broader economy and prices adjust upward, financial intermediaries have already captured substantial wealth from the monetary expansion. The process works like sophisticated counterfeiting, except it's perfectly legal and institutionalized through central banking. Imagine if a private company could create money and spend it before anyone else realized more money existed. That company would become extraordinarily wealthy by purchasing real assets with newly created money before prices rose to reflect the monetary expansion. This is precisely how the Federal Reserve System enriches financial intermediaries at the expense of ordinary Americans. Wall Street's trading profits, massive bonuses, and ability to survive repeated crises become understandable when viewed through this monetary lens. They aren't generating wealth through superior market insights or efficient capital allocation, they're capturing wealth through privileged access to newly created money. The more the Federal Reserve expands the money supply, the more wealth flows from productive Americans to financial intermediaries. This system explains why Wall Street consistently supports expansionary monetary policies regardless of their stated political affiliations. Democrats and Republicans may disagree about fiscal policy, but both parties support Federal Reserve independence and aggressive monetary stimulus during economic downturns. Wall Street benefits from monetary expansion regardless of which political party controls government because the fundamental money creation mechanism remains unchanged. Chapter 3: The Economics of Financial Advice Industry. The financial advice industry represents a fascinating case study in how market distortions create entire sectors that consume resources while producing minimal value. Through praxeological analysis, we can understand exactly how this industry extracts wealth from American savers while delivering services that sound money principles would make largely unnecessary. Consider the fundamental contradiction at the heart of professional financial advice. If these experts possessed superior knowledge about future market movements, they would use that knowledge to generate extraordinary personal wealth rather than selling advice to others. The fact that they choose to earn fees by managing other people's money reveals the true nature of their supposed expertise. Wall Street financial advisors operate in an environment where success is measured not by absolute returns, but by relative performance against arbitrary benchmarks and fee generation. This creates perverse incentives where advisors benefit from portfolio complexity and frequent trading activity regardless of whether these actions improve client outcomes. The more complicated they make your investments, the more indispensable their services appear. The industry thrives on exploiting Americans' legitimate concerns about inflation and economic uncertainty while offering solutions that often exacerbate these very problems. They sell complex products with high fees, frequent turnover that generates transaction costs, and strategies that require ongoing professional management. This approach guarantees continued revenue streams for financial intermediaries while potentially reducing net returns for investors. Observe how financial advisors present their services: detailed analyses of market sectors, sophisticated asset allocation models, and personalized investment strategies tailored to your specific situation. This elaborate presentation obscures the simple reality that most professional investors consistently underperform basic market indices after accounting for fees and transaction costs. The complexity serves primarily to justify expensive charges for services that automated index funds provide more effectively at minimal cost. The praxeological approach reveals that successful wealth preservation follows simple, logical principles that don't require professional intermediation. Diversified ownership of productive assets, consistent saving from income, and protection against monetary debasement through sound money holdings accomplish wealth building more reliably than complex strategies requiring ongoing professional management. Wall Street's financial advice industry represents a classic example of what happens when government intervention distorts natural market processes. Federal Reserve monetary policy creates artificial demand for complex financial services by making simple wealth preservation strategies ineffective. When government destroys the purchasing power of money through inflation, citizens must seek alternative stores of value, creating opportunities for financial intermediaries to sell expensive solutions to problems the government created. The industry's growth parallels the expansion of fiat money systems and central bank intervention in financial markets. During the gold standard era, wealth preservation was straightforward: save money in sound currency that maintained purchasing power over time. The complexity of modern financial planning exists primarily because government monetary policy has eliminated this simple, effective approach to wealth preservation. Chapter 4: Investment Banking's Wealth Extraction Model. Investment banking represents perhaps the most sophisticated wealth extraction mechanism in the modern American economy, operating through a complex web of privileged relationships, regulatory capture, and systematic exploitation of monetary policy advantages. Understanding this system reveals how a relatively small number of firms capture enormous wealth from productive economic activity while contributing minimal actual value. The core of investment banking profitability lies not in efficient capital allocation or superior market insights, but in privileged access to information, regulatory protection, and direct relationships with central banking authorities. When corporations need to raise capital through stock offerings or bond issuances, investment banks position themselves as essential intermediaries, capturing substantial fees for facilitating transactions that modern technology could accomplish more efficiently and cheaply. Consider the typical initial public offering process, where investment banks charge fees representing 3 to 7% of the total capital raised. For a $1 billion offering, this represents $30 to $70 million in fees for services that primarily involve marketing shares to institutional investors and managing regulatory compliance. The banks justify these enormous fees by claiming they provide market expertise and risk management, but praxeological analysis reveals they're primarily extracting wealth from the capital formation process. Investment banks benefit enormously from Federal Reserve monetary policy through multiple channels. When the central bank maintains low interest rates, it becomes cheaper for banks to borrow money for their trading operations and easier for them to finance large transactions. Additionally, monetary expansion increases asset prices across financial markets, generating higher fees from merger and acquisition activity, underwriting services, and trading operations. The revolving door between investment banks and government regulatory agencies creates a system where industry insiders design the very rules that govern their own activities. Former Goldman Sachs executives regularly assume senior positions at the Treasury Department, Federal Reserve, and Securities and Exchange Commission, while government officials frequently join investment banks after leaving public service. This regulatory capture ensures that new financial regulations often benefit large investment banks while imposing costs on smaller competitors. Wall Street's political influence extends far beyond traditional lobbying activities. Investment banks contribute substantial amounts to political campaigns, employ armies of lobbyists, and provide lucrative speaking fees and consulting arrangements to former government officials. This comprehensive influence operation ensures that government policies consistently favor financial intermediaries over productive industries. The system becomes more sophisticated through complex financial instruments that most Americans don't understand but ultimately pay for through higher costs and reduced economic efficiency. Credit default swaps, collateralized debt obligations, and other derivatives create additional layers of intermediation that generate fees for Wall Street while adding minimal economic value. These instruments often increase systemic risk while concentrating profits among financial institutions. Investment banking's wealth extraction model depends fundamentally on maintaining artificial scarcity of financial services through regulatory barriers and complex transaction structures. In a truly free market with sound money, many of these services will become unnecessary or be provided much more efficiently through direct market mechanisms without expensive intermediation. Chapter 5: Why Market Crashes Benefit Wall Street. Market crashes represent extraordinary profit opportunities for Wall Street firms while devastating ordinary American investors, creating a perverse system where financial intermediaries benefit from the very instability that destroys middle-class wealth. Understanding this dynamic reveals how the current financial system systematically transfers wealth from productive citizens to privileged financial institutions during periods of economic crisis. Wall Street firms profit from market volatility through multiple mechanisms that most Americans never understand. During market crashes, asset prices fall dramatically, creating buying opportunities for institutions with access to Federal Reserve credit facilities and large cash reserves. While ordinary investors panic and sell at depressed prices, major financial institutions acquire valuable assets at steep discounts, positioning themselves for substantial profits when markets recover. The Federal Reserve's response to market crashes consistently benefits Wall Street at the expense of savers and productive workers. When markets decline significantly, the central bank typically responds with aggressive monetary expansion, lowering interest rates and purchasing securities directly from financial institutions. This intervention provides immediate liquidity to banks and investment firms while systematically reducing the purchasing power of savings held by ordinary Americans. Observe how different types of market participants experience market crashes. Individual investors see their retirement accounts and savings decline in value, forcing many to delay retirement or reduce living standards. Small businesses struggle to access credit as banks become more risk-averse. Workers face unemployment as companies reduce operations during economic uncertainty. Meanwhile, Wall Street firms receive government bailouts, Federal Reserve support, and opportunities to acquire distressed assets at bargain prices. The moral hazard created by this system encourages excessive risk-taking by financial institutions because they can privatize profits during good times while socializing losses during market crashes. Investment banks know that government intervention will protect them from the consequences of their risky activities, creating incentives to engage in increasingly speculative behavior that generates short-term profits but increases systemic instability. Market crashes also create demand for Wall Street's crisis management services. During periods of financial stress, corporations need emergency financing, merger and acquisition advice, and restructuring services. Financial institutions position themselves as essential partners for navigating economic uncertainty, generating substantial fees from companies struggling to survive market downturns. The psychological impact of market crashes serves Wall Street's long-term interests by reinforcing the narrative that markets are too complex and dangerous for individual participation without professional guidance. Each major market decline creates a new generation of investors convinced they need expensive financial advisory services to protect their wealth from future volatility. Federal Reserve policy during market crashes consistently follows the same pattern: massive monetary expansion that benefits financial institutions while imposing inflation costs on the broader population. The central bank purchases bonds from Wall Street firms at above-market prices, provides unlimited lending facilities to major banks, and maintains near-zero interest rates that eliminate returns on safe savings while encouraging speculative activity. This system explains why Wall Street consistently opposes meaningful financial reform and sound money policies that would prevent artificial boom-bust cycles. The current monetary system generates the very instability that creates their most profitable business opportunities. Returning to sound money principles would eliminate artificial credit expansions that create market bubbles and the subsequent crashes that Wall Street exploits for enormous profits. Chapter 6: The Education Scam: Why Business Schools Teach Keynesian Economics. American business schools serve as intellectual training grounds for future Wall Street employees, systematically indoctrinating students with Keynesian economic theories that support financial industry interests while suppressing Austrian economic principles that would expose the system's fundamental flaws. This educational manipulation represents one of the most successful propaganda campaigns in modern history. Business school curricula consistently promote the myth that active government intervention and central bank management improve economic outcomes compared to free market processes. Students learn elaborate mathematical models that assume government officials possess superior knowledge about optimal economic policies compared to millions of individual market participants making voluntary choices. These models provide intellectual justification for the very policies that enrich financial intermediaries at the expense of productive economic activity. The emphasis on complex mathematical modeling in economics education serves multiple purposes that benefit Wall Street's business model. First, it creates the impression that economic understanding requires advanced technical training only available through expensive graduate education. Second, it obscures simple logical principles of human action with complicated formulas that distract attention from fundamental economic relationships. Third, it produces graduates who view markets as mechanical systems requiring expert management rather than spontaneous coordination mechanisms. Consider how business schools present monetary policy. Federal Reserve officials are portrayed as wise technocrats who use sophisticated tools to optimize economic performance through careful interest rate adjustments and money supply management. Students never learn that central banking represents systematic wealth transfer from savers to borrowers, from productive workers to financial intermediaries, and from future generations to current government spending programs. The complete absence of Austrian economic education in major business schools isn't accidental, it's essential for maintaining Wall Street's intellectual monopoly. Austrian principles would teach students that free markets coordinate economic activity more efficiently than government intervention, that sound money preserves wealth better than fiat currency systems, and that entrepreneurial profit comes from serving consumer needs rather than manipulating financial markets. Wall Street firms recruit heavily from business schools that teach Keynesian economics because these graduates arrive pre-programmed to support policies that benefit financial intermediaries. They've been taught that monetary expansion stimulates economic growth, that financial markets require regulation by expert government agencies, and that complex financial instruments improve economic efficiency. These beliefs make them perfect employees for an industry that profits from government intervention in monetary and financial systems. Business school professors who teach Austrian economics face systematic discrimination in hiring, tenure, and promotion decisions. Universities depend on donations from Wall Street firms and government grants that support Keynesian research, creating powerful incentives to suppress alternative economic perspectives. The few professors who attempt to teach Austrian principles often find themselves marginalized within their academic departments. The student loan system that finances business education creates additional incentives to support Wall Street's preferred economic policies. Students graduate with substantial debt that requires high-paying jobs in financial services to repay. This debt burden makes graduates dependent on the very industry that benefits from the economic theories they've been taught to support. Observe how business school graduates approach economic problems. They instinctively reach for government solutions rather than market mechanisms, prefer complex regulatory schemes over simple property rights enforcement, and assume that financial crises require bailouts rather than allowing market forces to liquidate bad investments. This intellectual conditioning serves Wall Street perfectly because it produces employees who genuinely believe their wealth extraction activities benefit society. The transformation of American business education represents one of Wall Street's greatest strategic victories. By controlling the intellectual foundations taught to future business leaders, they've created a self-perpetuating system where each new generation of graduates supports policies that enrich financial intermediaries while believing they're promoting sound economic principles. Chapter 7: How to Escape Wall Street's Wealth Extraction System. Escaping Wall Street's systematic wealth extraction requires understanding and applying fundamental economic principles that render most financial intermediation unnecessary. The path to genuine financial independence lies not in sophisticated investment strategies, but in simple, logical approaches based on human action principles that have preserved wealth throughout history. The foundation of financial independence is understanding sound money principles that Wall Street desperately hopes you ignore. Throughout history, gold has maintained purchasing power across centuries while every fiat currency has eventually become worthless through government debasement. Physical gold ownership provides protection against monetary debasement without requiring ongoing fees to financial intermediaries. This simple wealth preservation strategy eliminates the need for complex portfolio management services that generate profits for Wall Street while adding minimal value for investors. Direct ownership of productive assets represents another powerful method for bypassing Wall Street's extraction mechanisms. When you own rental real estate, shares in profitable businesses, or other income-generating assets directly, you capture all the economic returns without paying management fees to financial intermediaries. This approach requires more personal involvement than passive investment through Wall Street funds, but it provides greater control and eliminates ongoing fee extraction. Developing entrepreneurial skills offers the most powerful method for wealth creation while remaining completely independent of Wall Street's financial system. When you build valuable skills and create products or services that others want, you generate wealth directly through productive economic activity rather than hoping that financial market speculation will preserve your savings. Entrepreneurship creates wealth through serving consumer needs, making you independent of both government monetary policies and Wall Street's investment products. Understanding Austrian business cycle theory protects you from the boom-bust cycles that Wall Street exploits for profit. When you recognize that Federal Reserve credit expansion creates artificial economic booms that must eventually collapse, you can position yourself to benefit from these cycles rather than becoming their victim. During artificial booms created by monetary expansion, avoid speculative investments and focus on building cash reserves in sound money. During the inevitable busts, use your sound money holdings to acquire valuable assets at depressed prices. Minimizing exposure to the banking system reduces your vulnerability to wealth confiscation through inflation and financial crisis. Maintain only the minimum bank deposits necessary for monthly expenses, keeping longer-term savings in forms that banks cannot loan out or governments cannot easily confiscate. This strategy protects your wealth from both monetary debasement and the systemic risks created by fractional reserve banking. Education in Austrian economic principles provides the intellectual foundation for making sound financial decisions throughout your life. Understanding human action, subjective value theory, and spontaneous order principles enables you to evaluate investment opportunities, business ventures, and economic policies based on logical reasoning rather than Wall Street's self-serving recommendations. This knowledge becomes increasingly valuable as government intervention creates more complex economic distortions. Building local community relationships and developing practical skills creates resilience against economic uncertainty that no financial investment can provide. When you know local farmers, craftsmen, and service providers, You can meet many needs through direct exchange rather than relying on complex supply chains that depend on stable financial markets. These relationships provide security that survives even severe economic disruptions. The most important realization is that wealth preservation and creation don't require complex financial sophistication. They require understanding and applying simple economic principles that governments and Wall Street work constantly to obscure. Sound money, productive assets, entrepreneurial skills, and community relationships provide more genuine financial security than any investment portfolio managed by expensive financial intermediaries. Success comes from recognizing that Wall Street's complexity serves their interests, not yours. The simpler and more direct your approach to wealth building, the less opportunity exists for others to extract fees and commissions from your economic activity. Conclusion. Wall Street's greatest fear is educated Americans who understand that sound economic principles make most financial intermediation unnecessary and counterproductive. The complexity they promote serves primarily to justify expensive services that simple, logical approaches accomplish more effectively without ongoing fees and commissions. Through praxeological analysis, I've shown you that markets operate according to understandable principles of human action, not mysterious forces requiring expert interpretation. Sound money principles, direct asset ownership, entrepreneurial development, and Austrian economic education provide genuine financial independence that Wall Street's products cannot match. The choice before every American is clear: continue supporting a system designed to extract your wealth through complex fee structures and monetary manipulation, or embrace simple economic principles that have preserved and created wealth throughout human history. Wall Street profits from your ignorance of these principles, which is why they're never taught in mainstream financial education. The Federal Reserve System, fractional reserve banking, and government intervention in financial markets create artificial complexity that benefits intermediaries while harming productive citizens. Understanding these distortions empowers you to avoid their wealth-destroying effects while positioning yourself to benefit from the inevitable corrections that market forces eventually impose. Remember that economic truth ultimately prevails over politically popular fallacies, regardless of how many prestigious institutions promote erroneous theories. Austrian economic principles provide reliable guidance for navigating economic uncertainty because they're based on logical analysis of human action rather than mathematical models that assume away the very uncertainties that make economic calculation necessary. The path to genuine prosperity lies through understanding and applying correct economic principles, not through surrendering your financial future to institutions that profit from keeping you dependent on their expensive services.